Let me take you back to a moment in time, not too long ago. It was a chilly Tuesday morning, and I remember sipping my coffee while scrolling through the financial news. Suddenly, the headlines were blaring, "Market plummets amid uncertainty." My heart skipped a beat. It was one of those days when the stock market seemed like a turbulent ocean with waves crashing unpredictably. I paused and thought, how do we navigate this storm? The truth is, we all face this question at some point. Markets are inherently volatile. They rise, they fall, bringing emotions alongside: fear, anxiety, excitement, even greed. Today, I want us to dive into this fascinating world of market volatility and explore how we can sail smoothly, even when the waters are rough. Let's start with a metaphor. Think of the stock market as the weather. It can be sunny, rainy, stormy, or calm. Just like weather, market conditions change, sometimes without much warning. And just like in real life, while we can't control the weather, we can control how we prepare for it. We carry an umbrella if it's likely to rain and wear a hat on a sunny day. This is the essence of navigating market volatility: preparation and adaptability. You might wonder, why does market volatility happen? Imagine a bustling marketplace where traders shout, haggle, and occasionally panic. That's exactly what happens in financial markets. A mix of news, economic data, political events, and investor emotions create ripples, causing prices to move up and down. Take the 2008 financial crisis, for example. It began with the U.S. housing market collapse, but quickly spiraled into a global financial meltdown. Investors were scared, unsure of what tomorrow would bring. Amidst the chaos, those who had a clear strategy were like skilled sailors, navigating through the tempest, while others were left adrift. But here's the silver lining. Volatility isn't necessarily bad. In fact, it's part of what makes investing exciting and potentially profitable. It's like riding a bike. The thrill of speed is part of the allure, yet you balance carefully to avoid falling. Volatility can offer opportunities to buy undervalued stocks or sell at a premium. The key is to hold on to a guiding principle: long-term wealth building, not short-term speculation. Let's approach this with a mental model known as time in the market, not timing the market. Imagine planting a tree. It grows stronger, roots deepen, and branches extend over time. You wouldn't uproot it at the first sign of a storm, right? Likewise, a long-term investment strategy requires patience and resilience, allowing your investments to grow through market cycles. Remember, fear and greed are powerful market forces, yet they're two sides of the same coin. During market downturns, fear can lead us to make hasty decisions, like selling stocks at a loss. On the flip side, greed during bull markets may push us to take unnecessary risks. The real mastery lies in keeping both emotions in check and thinking rationally. Personal experiences can be enlightening. I recall a time during my early investing days when I was swayed by the excitement of a booming tech stock. I poured money into it and watched it soar, only to see it crash later. The adrenaline rush was real, but so was the lesson. Never invest more than you can afford to lose, and always have a diversified portfolio. Diversification is your best friend when it comes to managing risk. Think of it as not putting all your eggs in one basket. By spreading investments across various assets, stocks, bonds, real estate, you buffer against the impact of any single investment's poor performance. Let's dive a little deeper into the psychology of money. The human brain is wired to respond to uncertainty with caution. It's evolutionary, a defense mechanism from our ancestors. But in today's complex financial landscape, this instinct can sometimes hinder our financial decisions. Understanding our psychological biases, like overconfidence or herd behavior, can help us make better investment choices. Picture this. You're at a party, and everyone's talking about a hot stock. The excitement is contagious, and you're tempted to jump in. But pause for a moment. Is it driven by sound financials or just the latest trend? Emotional insight is crucial here. Knowing when to act and when to hold back is part of being a prudent investor. Ultimately, navigating market volatility comes down to a blend of education, strategy, and emotional intelligence. It's about having a plan and sticking to it, yet being flexible enough to adjust when necessary. It's about being curious and continuously learning, understanding the broader economic landscape, and keeping an eye on your financial goals. Now, as we wrap up, I want to leave you with a thought. Imagine you're standing at the seashore, watching the waves. Some are small, others large, some gentle, others fierce. Yet, despite their differences, the waves always come to the shore and recede, only to repeat the process. Similarly, markets will always have ups and downs. Your job is to remain grounded, keep learning, and focus on the horizon. So the next time you encounter market volatility, remember, it's part of the journey. Embrace it, learn from it, and let it guide you to becoming a better, wiser investor. Keep your financial destination in mind, and with each step, you're mastering the art of navigating the market's unpredictable yet fascinating landscape. Absolutely. Let's dive back in. So we were talking about how market volatility can stir up quite the cocktail of emotions. It's like stepping onto a roller coaster. And what's interesting is how our natural instincts might not always serve us well in this financial amusement park. When things get rocky, our immediate reaction is often to hit the brakes or, in investment terms, pull our money out. But this isn't always the best move. Consider this. Imagine you're in the middle of a storm out at sea. The waves are high, and it's tempting to change course and head back to shore. But seasoned sailors know to stay calm, keep their eyes on the horizon, and weather the storm because calmer waters usually await on the other side. In investing, this often means holding steady, staying true to your plan, and not making rushed decisions based on fear. Now let's talk about decision-making during these volatile times. It's crucial to have a clear plan before you even start investing. This plan should align with your financial goals, risk tolerance, and time horizon. When you establish this foundation, it becomes your anchor amidst the market waves. You can look back at your plan and remind yourself why you made these choices in the first place. One practical tip here is to review your investment strategy regularly, not just when there's a market shakeup. This helps ensure that your plan is still aligned with your goals and life circumstances. Plus, it gives you reassurance that your choices were made thoughtfully, not in a moment of panic. Let's not forget about diversification, which is like spreading your bets across different horses in a race. By investing in a mix of assets, such as stocks, bonds, or real estate, you reduce the risk of losing it all if one part of the market takes a hit. Think of it as not putting all your eggs in one basket. Diversification can provide some level of protection when markets are volatile because different asset types often don't move in the same direction at the same time. And then there's the emotional aspect of investing. It's perfectly natural to feel anxious when you see your investments dive in value. Recognizing these emotions is the first step in managing them. You might find it helpful to talk things through with a financial advisor or even a trusted friend who can offer perspective. Sometimes just speaking your thoughts out loud can help you see things more clearly. Remember, investing is a long-term journey. Trying to time the market by jumping in and out based on short-term news can often do more harm than good. Historical data shows that markets tend to recover over time, although past performance doesn't guarantee future results, of course. Staying invested, even when it feels uncomfortable, is often key to benefiting from the market's potential upside over the long haul. In closing, navigating market volatility is as much about understanding yourself as it is about understanding the markets. With a solid plan, a diversified portfolio, and a good grip on your emotions, you can ride out the storm and look forward to clearer skies ahead. Thank you for joining me today. Stay calm, stay informed, and remember, Financial success isn't about avoiding all the bumps in the road. It's about learning to handle them with confidence and resilience. Until next time, happy investing. All right, let's dive back in and continue exploring how we can navigate the often choppy waters of market volatility. Now that we've talked about understanding the nature of market swings, let's shift gears and focus a bit on our own reactions to these ups and downs. Because, truth be told, emotions play a massive role in how we manage our money. And when markets get bumpy, our emotions can sometimes lead us astray. Imagine this. You see your investments dropping in value. The instinct might be to panic and sell everything, kind of like jumping off a roller coaster mid-ride. The problem is, by doing so, you might lock in losses rather than ride out the storm and see your investments recover when the market turns back up. This is where having a solid plan can really help. Let's think about creating a plan like building a sturdy ship before a storm. If you have a well-thought-out investment strategy and a clear idea of your financial goals, you'll be more likely to stick to your course and not make rash decisions when markets get turbulent. This strategy might include things like diversifying your investments, which basically means not putting all your eggs in one basket. It's about spreading out your investments across different types of assets, like stocks, bonds, and maybe even some real estate or commodities. Diversifying can help cushion the blow if one area of the market isn't doing so well. Think of it like a well-balanced diet. You're more likely to stay healthy with a variety of nutrients rather than just relying on one food. But let's not forget, it's perfectly human to feel anxious. We all have that internal voice getting louder during downturns, questioning our choices. One way to silence that voice is by revisiting your investment strategy regularly. This doesn't mean changing your plan every time there's a market hiccup, but rather checking in periodically to see if your investments align with your goals and risk tolerance, which is just a fancy way of saying how much risk you can comfortably take on. Let's also talk a bit about the power of patience. Markets go up and down, but historically over the long term, they've trended upwards. By focusing on long-term growth rather than short-term hiccups, you can reduce stress and improve your chances of financial success. It's like planting a tree. You don't expect it to grow into a giant oak overnight. You water it, care for it, and give it time to grow. So, in summary, remember, it's okay to feel the emotional waves that come with market volatility. They're natural. What matters is how we respond to them. Having a clear plan, staying diversified, and focusing on the long term can help us navigate through the storm. And always keep in mind, when in doubt, it's perfectly fine to reach out for advice, whether it's from financial advisors, reading and learning, or simply talking it over with someone whose opinion you trust. Building a good financial future is not a solo journey. It's about using your resources and community wisely. All right, on that note, let's wrap it up here for today. I hope you feel a bit more prepared and calm when you see those market headlines. Remember, you've got this. Until next time, stay informed, stay patient, and take care.